going into the Income Tax Act, and especially going into the general deduction formula in Section 11A. Now, you'd be very familiar with the wording of the general deduction formula that allows the deduction of expenditure and losses actually incurred by a taxpayer during the year of assessment in the production of income other than expenditure and losses that are capital in nature. This particular case is concerned specifically with that aspect of whether the expenditure was actually incurred in the production of income. So all of the other aspects were accepted, that there was expenditure actually incurred, not of a capital nature, but the question was whether it was in the production of income of the taxpayer. And it concerned the payment of a contribution to an employee share incentive trust. And the first question was whether there was a sufficiently close connection between the contribution and the taxpayer's income-producing operation. So going back to the cases like Port Elizabeth Electric Tramway case and so on, what was the purpose of the expenditure, and was there sufficiently close connection between the expenditure incurred and the income-producing operations of the taxpayer? If there's not a sufficiently close connection, then the expenditure would not be regarded as being in the production of income of the taxpayer and would not qualify for deduction. Now, the second question, so the first question was saying, would it be allowed as a deduction? Second question, if it was not allowed, if the finding was that there was not a sufficiently close connection and therefore the deduction of the expenditure was not allowed, then we look at this question of prescription, because SARS had raised additional assessments on this taxpayer, and those additional assessments were raised more than 3 years after the original assessments. And the taxpayer was arguing that SARS was precluded from raising those additional assessments in terms of the prescription provision in Section 99 of the Tax Administration Act. Well, we'll have a look at that. It's interesting that this case was actually a matter that had gone on appeal from the Western Cape High Court. In fact, this case has followed all the way through from the tax court to the Western Cape High Court and then on to appeal through to the Supreme Court of Appeal. And so it's really gone through all layers of the courts looking at this question of whether there is a sufficiently close connection between the expenditure incurred and the production of income, whether it's sufficiently closely connected to the income-producing operations of the taxpayer. Now, the witnesses for the taxpayer, this Spur Group Pty Limited, had of course argued that the payment to the incentive trust was paid to keep a happy and contented workforce. It was paid to motivate the employees of the particular company. However, we will see that it wasn't as easy to determine as that. It wasn't as conclusive as that. It wasn't simply a case of saying this is a trust that has been set up purely for the benefit of the employees of this particular company. This is a company within the group. It's an operating entity within the Spur group of companies. It's a wholly owned subsidiary of Spur Corporation Limited, which we refer to as Spur Holdco in this discussion. And what had happened is that Spur Holdco had established this trust, the Spur Management Share Trust. It was a discretionary trust. And importantly, Spur Holdco was determined in the trust deed as the sole capital and income beneficiary of the trust. Now, Spur Holdco is a separate entity to the company that we are dealing with here, Spur Group Pty Limited. And of course, if we are looking at the deduction of expenditure of Spur Group Pty Limited, we need to establish that the expenditure incurred by Spur Group Pty Limited was incurred for the production of income of that particular company. We would look back at the Solar Glass case where we had a group situation, and that case and that judgment made it very clear that expenditure incurred that's going to benefit the group as a whole is not incurred in the production of income of the particular taxpayer necessarily. All right, so, and that's really what was happening here, is that we had a trust and we had different companies in the Spur Group involved with this trust. The trust deed, as I say, established the holding company, Spur Holdco, as the sole capital and income beneficiary when the trust was formed in 2004. Later on in 2010, some years later, the trust deed was amended, and then it was amended to allow the participants to benefit from the dividend income, but Spur Holdco remained the sole capital beneficiary of the trust. Now, the events were as follows. So this trust was set up in 2004, November 2004. In December 2004, our taxpayer, Spur Group Pty Limited, concluded a contribution agreement with the trust and paid an amount of 48 million rand to the trust. The trust used that money to acquire 1,000 preference shares in a new company, Newco, and those shares were actually redeemed 5 years later in December 2009. The 48 million rand was ultimately returned to the trust and remained in the trust, so it never actually went out to the participants. Now, Spur claimed that that contribution that it paid into the trust was made as an expenditure incurred in the production of its income. It was there to motivate its employees, as one would expect a share scheme would do. It was paying this amount up front, and the benefit would be derived over a period of time, and therefore it did spread the deduction of the expense over the period that the benefit was derived in terms of Section 23H. So it did only claim in the 2005 year of assessment 3.5 million, let's call it. From 2006 to 2011, it claimed 6.9 million in each year, and then 3.5 million in 2012. So you'll see that it did spread the deduction. And it was basically all of these years that SARS had reassessed and disallowed the deduction of the contribution. So it wasn't a once-off deduction. It was actually spread over this period from 2005 to 2012, applying the provisions of Section 23H. Now, the Commissioner argued that the contribution to the trust did not qualify for deduction under the general deduction formula because it was not incurred for the production of the income of Spur Group Pty Limited. It said that actually Spur Holdco was the sole beneficiary of the trust and was the only party to have benefited directly from the contribution to the trust, as the trust had actually distributed the preference share capital and the preference share dividends to the beneficiary, Spur Holdco, not to the participants, not to Spur Group Pty Limited. So the participants, the Commissioner argued, were not actually the beneficiaries of the contribution. The causal link, that link, was there a sufficiently close link between the expenditure incurred and the income producing operations of the taxpayer? The Commissioner argued that that was lacking and said that the contribution was not expenditure incurred in the production of Spur Group Pty Limited's income as required in terms of Section 11A, that there was only an indirect and insufficient link between the expenditure and any benefit arising from the incentivization of Spur's key staff members. It's interesting that in the tax court judgment, it does note there that one of the witnesses, that was actually the tax director of the tax advising company in this regard, was arguing that a more holistic approach should be taken instead of just looking at the immediate beneficiary. And here we see the immediate beneficiary was Spur Holdco, that there should be a more holistic approach that is taken, looking at the overall structure of the trust and the various companies within the group. But we see here that when this case went on appeal up to the SCA, although the taxpayer was successful when the case in the tax court and then again in the High Court, but when it went through to the SCA did look actually at who the beneficiaries of this trust really were and who was benefiting from this 48 million rand payment. And because there was not a direct indication of the Spur Group Pty Limited staff members actually benefiting, they said that the real beneficiary was actually the holding company, not the company making the payment. And therefore, there was not a sufficiently close link that was demonstrated by the company making the payment. So in the judgment, it is stated that the contribution of 48 million rand was used wholly to subscribe for preference shares in Newco. Only the trust held the Newco shares, and only the trust was entitled to the return of the 48 million rand contribution and preference dividends. So the participants, the employees of Spur Group Pty Limited, had no right to participate and no ability to benefit in any way from this 48 million rand that went into the trust and was then used to invest in these new co-shares. Importantly, it was stated in paragraph 32 of the judgment that in terms of the trust deed, only Spur Holdco would, as the capital beneficiary, have any right to the ultimate delivery of the 48 million rand contribution. So the participants didn't benefit. They were neither capital nor income beneficiaries of the trust at that time. Now, I mentioned earlier that the trust deed was changed in 2010 to make the participants beneficiaries as far as the dividend income was concerned. And so one could argue that they would become entitled to dividends from 2010 onwards. But the point made in this judgment is that one must look at the time when the expenditure was actually incurred, when the payment of the 48 million was actually made. That was made in 2004. And so the fact that the trust deed was subsequently changed doesn't alter what happened at the time that this payment was made in 2004. And at that stage, they said that there was not a sufficiently close connection between the payment of the 48 million and the income earning operations of the taxpayer. Having come to that conclusion and therefore saying that the expenditure will not be allowed as a deduction, of course, SARS had now raised all of these additional assessments, and the question was whether SARS had done that correctly in terms of the legislation. So we look at the original assessment and when these additional assessments were raised. So the additional assessments were all raised in July 2015. And as far as your 2005 year of assessment was concerned, that assessment was raised in May 2007. 2006 was assessed in August 2007, 2007 in May 2009, and so on. All right, 2008 and 2009. And all of those years were then reassessed by SARS in July 2015. So clearly all beyond that 3-year limitation period. So when we look at that 3-year limitation period in Section 99 of the Tax Administration Act, that section provides that the Commissioner may not raise an assessment more than 3 years after the date of the original assessment. However, that restriction falls away where the assessment by SARS was not fully done and correctly done because of fraud, misrepresentation, or non-disclosure of material facts. So in Section 99(2)(a) provides that in the case of assessment by SARS, the fact that the full amount of tax chargeable was not raised or not assessed due to fraud, misrepresentation, or non-disclosure of material facts on the part of the taxpayer. So then we look at this question of whether, in fact, there was fraud, misrepresentation, or non-disclosure of material facts on the part of the Spur Group. Now, SARS alleged that the amount of tax chargeable was not properly assessed exactly because of misrepresentation and non-disclosure. In the 2005 income tax return, SARS had actually answered no to the following questions. Were any deductions limited in terms of Section 23H? Now, we've just seen that, in fact, Section 23H had been applied by the taxpayer and they had spread that 48 million rand. They'd only deducted a certain amount in the 2005 year of assessment, and then they had deducted tranches of that expenditure in the subsequent years. So clearly they had applied Section 23H, and yet they answered no to that question. They also answered no to the question, did the company make a contribution to a trust? Clearly they had made a contribution, and yet they answered no. And they answered no, was the company party to the formation of a trust? And we see that the trust was formed in November 2004. Clearly within the 2005 year of assessment of Spur, and yet Spur answered no to that question. And in the 2006 income tax return, Spur again answered no to the question about whether there were any deductions limited in terms of Section 23H. In the judgment, it is actually stated, the words used are that it boggles the mind that Spur had answered no to these questions. It seems unbelievable, but it had actually answered no to those questions. And then in each of the 2005 through to 2008 tax returns, the amount of deductions claimed in respect of the contribution limited by Section 23H were disclosed under the category of other deductible items rather than the correct place under the line item prepaid expenditure as limited by Section 23H. Now, all of these things together led to the conclusion that actually Spur had made misrepresentations on its tax returns, okay, for all of those years. Now, Spur's defense to that allegation of misrepresentation and non-disclosure of material facts was that their statements were negligently and inadvertently made. They didn't mean to answer those questions incorrectly, and they asserted that the Commissioner had failed to establish the requisite causal nexus in that it was unclear how Spur's incorrect disclosures would have altered the basis of the Commissioner's assessment. So Spur submitted that the onus to establish a causal nexus was actually on CSARS, and that they had not discharged their onus, and therefore they said that the additional assessments issued were unlawful, invalid, and cannot be confirmed. Now, the court took a dim view of Spur's counter allegations there, and they came to the conclusion that Spur had actually made false statements in the tax returns. In the judgment, paragraph 63, it stated, "I shall also add that as a matter of policy, a court would be loath to come to the assistance of a taxpayer that has made improper or untruthful disclosures in a return. Clearly, this would offend against the statutory imperative of having to make a full and proper disclosure in a tax return." Going on to say, in the light of what has been stated above, the conclusion was that the misrepresentations and non-disclosures by Spur caused the Commissioner not to assess Spur correctly, and then, as a result of that, the 3-year prescription period fell away. And so SARS was legitimately able to raise these additional assessments all those years later. And all of the assessments for the years 2005 through to 2012, the additional assessments raised by SARS, in which all of those deductions comprising the 48 million rand contribution, all of those deductions were disallowed. And then, of course, there would have been penalties and interest as well. So, I've seen some of the commentary around this judgment, which was just released in the week prior to me making this recording, seems to have caused quite a lot of shock and horror. But the bottom line of it is that I think the lesson that we can learn from this judgment is to be extremely careful when completing those tax returns, and especially when answering those various questions, because incorrectly answering those questions can result in the taxpayer being regarded as having made misrepresentations in their tax returns, and of course that can then result in that 3-year prescription period falling away. All right, so just to be extremely careful, be very careful to read the questions carefully and to make sure that obviously that the correct answers are provided, and that there's no misrepresentation and no disclosure, that anything that needs to be disclosed in those tax returns is properly disclosed.